Just think about it. The baby boomers alone hold more than 54% of all the stocks on the stock market. And these people are either retiring or already retired. Not to mention, yesterday I watched a video where the new companies who are trying to take over the credit card businesses are buy now, pay later. And the three companies that currently are competing with credit card companies. And effectively, they're in some way operate like a credit card company because they still charge you a late payment fee, which happens to be an interest, which is the same system the credit card companies uses, right? If you really think deeply, Mark Zuckerberg is kind of a Jim Cramer in the technology sector. Think about all the predictions and investments that he and his company actually did and quite went completely in the opposite direction. Think about the metaverse, think about the VR headset, acquiring companies here and there. $20 billion completely lost. They just recently closed not only the project around the metaverse, he fired all the people who were actually working on the metaverse. And there are many other different projects I got reminded by Perplexity, of course, that illustrate that in some form or shape, if you are able and capable and kind of interested to follow the both sectors, the stock market, the Jim Cramer, the person who, is usually mocked for being wrong and then trying to fix what he said, betting on the opposite side, being wrong again. One of the greatest of all time was when Meta fell under $100. He apologized that he was bullish on Meta. The following year, Meta made all-time high. The best performing stock, very close to Nvidia. Percentage-wise, was actually bigger than Nvidia. So again, Jim Cramer was very, very off this prediction as well. But the main point here is that if you zoom out, considering the current acquisition from Meta in Manus AI, right? If you just follow the AI sector, of course, if this is something that interests you, you probably will be more interested to follow the development, and maybe we're actually experiencing the top in the AI boom, because these guys were late big time for the AI hype, and they figured it out, and they didn't want to miss the train, and they doubled down. Something very opposite with the metaverse. With the metaverse, they thought that they're the first one, they're the innovators, they're the pioneers. That's why they tripled on $20 billion. And in the end, they were the only one in the room. There was no one else investing in the metaverse. Even people who purchase land, sell land, develop games in real estate in the metaverse. Remember, people were saying the Empire State Building in the metaverse. People were saying, Smokehouse next to the Adobe House. All these pretty, I would say, comic book realities where a lot of people were buying, and the prices were, $3,000, $4,000, $5,000, $6,000. Some people flipped this virtual land, make money, but the overall concept, the whole idea of Zuck, the person who was a human, right? Before, it didn't play out. It didn't play out because the people didn't engage. And even Microsoft tried to help the push and the adoption of the VR headset. I personally went here to the flagship store on Fifth Avenue in Microsoft on the second floor to try the VR headset, try to, understand what is the whole hype about. I didn't find it engaging. It was uncomfortable, heavy. I don't know, maybe very, very, very young kids. Maybe they tried to kill some time, but it was boring. Then Apple, right before Zuck leave the project and fired all the team, Apple picked up from the same spot, but they implemented the whole new reality. Remember this 5000? I forgot what was the name. It's like Apple Vision Pro or something like this. So yeah, but the concept is completely different. You in fact can work from this device that Apple built versus the Zuck, where he was like hang out with friends and like a WhatsApp virtual reality world where no one actually was interested. The point here that I'm trying to make, of course, let me remind you, we just stretched for a while, is that if you really see and read between the lines, Zuck might actually be the Jim Cramer in the technology sector, and he might actually be the indicator that you want to follow if you're investing in some of these AI companies that Meta either acquired or is planning to acquire or is partnering with. Again, this is do your own research and due diligence. For my own personal consideration, I think that the Manus AI is overhyped. And I think unique. I haven't seen anything that the other chatbots cannot do. Also, it's slower, it takes much more time for research and deep research, and especially building projects. You have less credits, more expensive, so many disadvantages. But again, Zach probably has seen something that we don't know. I might, of course, be completely wrong, but if you just look at the pattern, if you look at the previous performance, you can kind of predict or have certain expectations about this project. Let's wait and let's see how many years it will take for the Zach to close down this project as well. We already heard maybe in late November he will stop hiring for the AI super intelligence team, right? Which was another indicator that, oh my gosh, we kind of overhired, we went off the rails type of situation. I don't know, it's just interesting. If you can, I understand it's very hard, but if you can follow two different domains of knowledge, and if you can spot similarities, and if you can spot the similarities and draw your own conclusion that is non-biased, right? You don't have to listen to me or anybody else, but like I spot this for myself, right? So I'm gonna make my own financial decisions based on what I see and the conclusions that I draw from it. But you can do the same exact strategy on something else. You might be into e-commerce, you might be looking what Shopify is trying to acquire, or what kind of apps Shopify implements. Remember, Shopify built a special payment app separate from Shopify. It was the Shop app, right? So you have to follow the whole infrastructure around the niche or the domain that you are actually making money, or you're investing, or maybe you have a career in tech, or maybe you really want to see what's going on. But like I said, if you can build the same system where you follow the trend, analyze the news on your own way, and create a comprehensive framework, okay, what this means, what I'm gonna do, and how I can actually either protect myself or make money from it. Are you gonna be waiting to see 2026 or 2027 potential recession, drawdown of the stock market? If you started investing 30-40 years ago, you're up 6,000-7,000%. Will you be waiting to see what the market has as a surprise for you? I don't think so. The problem here is that a lot of people speculating that these guys might be selling. And I understand this is a very large speculation. Why? Because if you look at the historic data, how these people actually vest their retirement funds or retirement accounts is usually on 4 to 6% on an annual basis. They're taking profits in these ranges, but like I said, this time around is different. Why? Because the market is at all-time high, and there is a major shift in the economy coming from the AI sector, which means a lot of other stocks that these people have been holding throughout the last 20-30 years may not see another high, right? We saw this with many companies that have been doing well, have been doing all right, have been paying dividends, some of which. But if you realistically see that some of these companies have no connection with the AI, they have no upside, they have no partnerships, and they cannot be left behind in this trend, well, you really want to prepare yourself for potential $25 trillion worth of securities and value being at some points maybe gradually dumped on the market. Let me give you a little economic perspective over here. If you currently have $2 million, in 40 years, if we adjust this amount with inflation, your $2 million will have a buying power of only $758,000. The other day I had a friend who is trying to acquire 2 different summer and winter resorts, right, outside of the US. And he was trying to identify, is this a good deal? Is he overpaying? What is the biggest risk associated with it? We sat down, right? We run the numbers. We look at one of the companies, it's a public company, the other company is private. We run the numbers on the public company. What you really want to focus and what you really want to understand, right? You have to have an idea. What are the assets of the company, right? Could be hotels, could be commercial infrastructure, which could be areas where people have stores, people have food courts, right? You rent out all these locations in the resort, and this is all come down as part of your commercial space for rent. This is a revenue source of your resort, right? On the flip side, you also have a chain of hotels which are inside the resort. As a matter of fact, majority of the liabilities of this resort are actually coming from hiring, employment benefits, maintenance of the buildings, because as you know, if you run hotels, all of these hotels, they should have, year-round water and electricity. You may not need to hire a full staff, but you still have to maintain the building, right? And also, we remember very well what happened with the building, with the condominium building in Miami, which essentially went to the ground, right? There was a structural issue whatsoever. So you understand that the book value of the public company, understanding the book value versus the value of just going on the open market, purchasing all the shares or making tender offer to acquire all the shares, is your main comparison, right? Starting point to value the deal. Meaning, let's say a company, in this particular example, this resort has 1 million shares in circulation that could be bought or traded on the open market. Let's say this company has $20 a share at this very moment, market price. Let's say you want to acquire the controlling package, which would be over 50%, right? You want to acquire 51%, you want to buy this amount of shares on the open market times $20 at the current prices, right? So you get the number, and then the corporate law will allow you to make a tender offer for the remaining 49%. You combine both numbers, how much out of pocket will cost you to acquire 90 to 95% or 100% of the company, versus how much is the company actually worth on the side, assets minus liabilities, which will give you the book value. So if it costs you to buy all the shares on open market, let's say 20, 30, 40 million dollars, but the assets minus liability is giving you $100 million, well, you're buying a very, very good deal, simply because if you close on the open market tender offer plus buying up the remaining shares and acquiring to the public offering, you essentially ending up with $40 million upside, which is not yet profit, because we all know there is a cost associated with the actual transactions. You most likely will need an investment bank to help you to essentially carry the deal, to broker a deal for you. You want to make sure that you have their own due diligence, because sometimes, somebody else has to look at the books. The books sometimes might be cooked. There might be different two ways of accounting, especially when we're talking about a company that is outside the US. So very important. This is your starting point. You don't have to be an expert, but you need to have your own idea and estimates of every single deal, where it makes sense, ballpark, and where it doesn't. Obviously, one of the biggest schemes that no one actually talks about, when you start counting your money, when you start trying to compute all the assets that you have minus liabilities at this very moment, trying to identify what is your actual net worth, is the problem of inflation. And inflation is your biggest enemy. It's not the prices going higher, it's not the taxes, it's not that some of your investments might not perform as you expect, might actually underperform the market, might underperform the treasuries, might underperform the passive investments, which could be in government paper or whatsoever. The biggest enemy remains inflation, because you're not really fighting inflation. The only way to fight inflation is to stay out of cash, and your cash sitting in assets which prices are going in the same direction with inflation. For example, if you have a portfolio of 10 cars, which are sports cars, which are, let's say, limited edition cars, one of 100, one of 300, etc., right? If these cars had MSRP of $150,000 and you purchase one car and you purchase 10 more cars, you create a portfolio, let's say you spend $15 million, right? Because inflation goes up 8-10%, you no longer have $15 million portfolio of cars. Your portfolio now worth maybe $20, $25, $30 million. This is why inflation actually works in favor of the rich people who own assets. Rich people who simply sit in cash, they don't really benefit. They in fact struggle as the poor people, because the asset appreciation is not there. In the beginning, AI was not even a thing, and in the end of this year, everything is AI. People no longer, even speak about crypto. If you look at all the positions that I have here, even on the forex markets, everything is closed. I have closed almost. I think I have only one open position on the stock market. I have 4 open on the crypto. The crazy part is that people usually overestimate the failure and underestimate the opportunities. Like they overestimate all the potential risks, everything that could go wrong, if you really think about it. You try to start a business, the first thought you had is all the things that will not work, that you can't do, that you saw somebody else fail to do so, right? People are not looking into, okay, you know what? I actually have some experience in this. I actually might have been positioned in the best way to succeed in this because I know this, I've done this, or I work alongside people who have done this. Like I said, people are sabotaging themselves all the time. I've seen people working the same job for like 3, 4, 5 years. They kind of like the job, but they don't see that the opportunity you can make more money, and they simply quit and shift to something else. And maybe 1.5, 2 years later, they see somebody on Forbes. He created a business out of this, and they kind of wonder, how is that even possible? Because they know they have experience, they know the industry, they know the business, but they simply didn't see the opportunity. Something that I just mentioned. I said people usually overestimate all the risks. If you're going to pine for gold, you don't really think, oh, I'm not going to find gold. You don't try to demotivate yourself. Why would you do that? If you really want to find gold, you're going to be optimistic. You're going to make sure that you give yourself the highest possibility chances. You're going to print all the maps, all the areas, all the research that has gathered together with the highest possibility of gold concentration in this particular area. And you're going to find all the tools that will give you the best chance to find gold. You're not going to go and, bring the least important tools or the least capable tools to help you find for gold, or you're not going to go in the middle of nowhere where there is no single study or research that has potential against gold. People are usually sabotage themselves. It's like you're going to have an MMA fight, right? You don't think, I'm going to lose. Not quite. You just prepare yourself and you give 100%. That doesn't mean you're going to win. 100% is not guaranteed to win, but it just gives you the highest possibility to actually achieve the success. Think about it. What could go wrong if you give 100%? That's an honest question. Think about it. A lot of people don't quite make it for 2 main reasons. They're either lazy to give the 100%, or they don't believe enough to give the 100%. Because if you're lazy, you're not going to give 100%. And if you don't really believe that something could happen or will happen, you're still not going to give the 100%. People usually give the 100% only when they're completely sure that something is very certain. It is going to happen, right? It's like you're trying to approach a glass of water. You're very certain you're going to get the glass of water because it's very obvious. They have a full concentration. They're approaching the glass. They grab the glass. They pull back. But this is a very simple example. People are not that certain in important things in life, which is kind of weird.